Hello and thanks for watching. My name is Spencer Gray. I'm the president and CEO of Gray Capital. We're a real estate private equity firm based out of Indianapolis, Indiana. We buy large multifamily apartment buildings, primarily in the Midwest, and also the host of The Gray Report, a weekly YouTube show and podcast focused on research reports, data, and tracking the multifamily commercial real estate markets and the economy. And one question that is being brought up every single day in the industry is now a good time to invest in multifamily, and at what cap rate? What is a good cap rate? It's an age-old question that new investors and old investors alike ask. And sometimes the question can get laughed at because it's all based on one's perspective and what a cap rate means to someone, and what a cap rate is, or a capitalization rate. It's essentially, it's not just your unlevered yield on cost, kind of the rate of return if you bought a property with cash. It's really more of a market sentiment of what is the demand at the current time in the market for multifamily real estate. And the challenging thing with cap rates is they're slow moving and they're very much a lagging indicator because it takes so much time between putting a project under contract and underwriting it to actually closing on that property. And there's an inherent relationship between cap rates and interest rates, although it's not always in lockstep. So we're talking about the spreads between cap rates and interest rates, looking at where they have been historically, going back about 20 years, and at different points in the economy, in the market, in different cycles, what was the difference? Again, we're not looking at pure rules, but just relatively, what is the difference between what the 10-year Treasury yield is throwing off, and the 10-year Treasury, often referred to as the risk-free rate, because when you buy a 10-year Treasury bond, typically it's received, there's not a whole lot of risk, but tell that to SVP and New Republic, who basically went under because they had so many Treasuries, mortgage-backed securities, that they weren't necessarily going to hold them to maturity. That's besides the point. We've put up some charts, used the good old whiteboard to really illustrate this. Because again, you talk to a broker, you talk to a buyer, you talk to people who are doing deals, you hear a big spread, especially if you're talking to a seller what they'd like to sell their property for, because there's been so much that has changed just in the last 12 months. Mostly because of interest rates. The entire economy has changed. But let's go back in time a little bit, look at where cap rates and interest rates were, so we can extrapolate a little bit to see what range should cap rates be trading in. Again, there's not going to be one rate, because different business plans call for different cap rates. You might be buying a lower cap rate on a value add project that you're going to force appreciation by renovating units and raising rents. By a lower cap rate because you're going to force all that value. You're going to force that appreciation. Now that may be more difficult in today's market, might still be possible, but it's relative. But again, with all things being relative, let's look at those relationships throughout history. Let's go back. So our purple line is cap rates. The red line is the 10-year Treasury. We've also added the BBB corporate bond yield because you ask a lot of folks, the BBB rate is a much higher correlated metric and rate compared to the 10-year Treasury, but so many people go off the 10-year Treasury and so many loans are based on the 10-year Treasury. It's what your financing is often based on fixed rate financing. It's what a lot of investors look at. So again, let's look at that relationship. Going back to 2002, again, we're just after the dot-com bubble and crisis. We're looking at a very healthy spread. Cap rates, they're all the way up in the 8% range. 8%. The 10-year Treasury is lower than it is today in October of 2023. It was kind of in the mid 4% range. Now the 10-year Treasury, while it did increase slightly through the early 2000s, multifamily cap rates were declining. But as you see, as interest rates rose, the 10-year Treasury rose, really kind of peaking in 2006, as well as corporate bonds peaking in 2006. What we saw at that point was an all-time low in the spread between cap rates in the 10-year Treasury, as well as cap rates in the BBB corporate bond. In fact, in 2006, we saw the BBB corporate bond invert and go higher than your average cap rate in the multifamily cap rate in the United States, while interest rates peaked. So this spread, again, has been a 20-year low up until today, very recently. It's a 150 basis point spread, or 1.5% percentage points difference between the cap rate, which was around kind of 6.5%, and the 10-year treasury, which was around kind of 4.6, or kind of in the mid 4% range. Now, fast forward, after that, there was a little bit of economic event, the Great Financial Crisis, 2008, 2009, in which we saw cap rates, BBB bond rates rise as the Federal Reserve lowered interest rates, bringing those rates all the way, hitting a low point in 2012, just below 2%. The lowering of the 10-year treasury allowed BBB bonds to drop incredibly fast in 2010, but it sent cap rates on a long trajectory downward. Again, starting at about 2009, just above 6.5%, 6.6, 6.7%, almost 7%, slowly moving down to where we bottomed out in 2021 and in 2022. Really, the fourth quarter of 2022, a few deals kind of lagged over into the fourth quarter of 21, lagged over to the first quarter of 2022, when according to this chart, and so this is CoStar data, cap rates were in basically the high 4% range. That's on average. Really, a lot of cap rates are trading in the 4% range to 4.5%. But on average, we're going to give them a little bit of kind of grace, and it's a little bit of a higher range. When interest rates bottomed out 2 years prior in 2020, during the pandemic, when the Federal Reserve lowered the Fed funds rate to 0, and the 10-year treasury bottomed out at 0.49%, we saw nearly an all-time difference in the spread. Basically hit a 410 basis point spread between the 10-year treasury and U.S. multifamily cap rates. The only time where we've seen a larger spread in the last 20 years was back in 2012, when the 10-year treasury bottomed and cap rates, were still moderately high. That's what created the opportunistic buying environment, or at least the perceived buying environment, in 2020, when that spread went to 410, as cap rates were still moderately high, kind of in the high 5s, kind of mid 5% range, but interest rates, again, just completely bottomed out. If you were able to purchase assets during this period or refinance, you were able to refinance at decent valuations and incredibly low rates. This made sense. We bought a lot of real estate during this period, locked in some excellent, just long-term, 10 to 30-year term debt, at mid 2s to 3% interest rates, an incredible period of time. But we all know what's happened. Starting in March of 2022, the Federal Reserve started raising interest rates. Inflation has been just beating just a hot drum, kind of peaking at about 7% CPI inflation, kind of in the middle of 2022 through 2023. Although inflation has come down over the past couple of months, it's remained very sticky, and the Federal Reserve has maintained interest rates, the Fed funds rates, at a high 5.25% to a 5.5% range on the Fed funds rate. And the 10-year treasury, while it was hovering kind of in the mid 3s and then to 4, it has surged recently, almost hitting 5%. So the problem, and again, begs the question, where should cap rates be today? You had sellers buying just last year at mid 4% rates, 4% cap rates. So let's apply that historical spread, kind of the tightest spread and the largest spread, again, looking at 150 basis points versus 440. The average cap rate spread is about 325. So if we, again, looked at that average spread, we should be kind of at an 8.25. That's probably not the half. But if you look at, again, the extremes, the tightest spread, going back to 2006, 150 basis points, we'd be at a 6.5 cap. So that should be the lowest cap rate that's trading in the market based on historicals. If we look at the widest spread, this 440 basis point spread back in 2012, we should be trading all the way up at a 9.3% cap rate. Again, taking the average over this entire period, where again, we spent a nice long period, this whole time here between really kind of 2008 and 2020, ending in 2021, was a great time to buy apartments based on this spread, the cost of capital and the yield produced by the underlying real estate itself, taking out a lot of speculation. It's hard to say today that purchasing a multifamily asset at cap rates where sellers would like to sell them at is sustainable and makes sense from a pure math and numbers standpoint. That's when we know that there's something wrong in the market and something has to change when the math just doesn't work. So when you hear from whether it's a broker or a syndicator that we just need to keep buying and it'll all work out and interest rates will lower again at some point and just make it work for us down the road, you really have to put a big asterisk next to that. And it's a lot of ifs and not certainty. So what would lead us to then say will happen over the next 3, 6, 9, and 12 months? Well, assuming that interest rates maintain a similar range, which there's nothing to indicate that they would deviate from that range, then we would expect cap rates to continue to move in an upward trajectory at a low point of 6.5, but we're really looking at a band, I think, between 6.5 and 8.5. I do believe the demand for apartments is higher than it was back in 2005, 2006. There's more interest, there's more institutional interest, there's more retail interest. We didn't build enough apartments during this period of time. Now we're building a lot right now. There's over 1 million units under construction that's being delivered. That's still not enough to fill the gap over the next 10 years, however. And we're setting ourselves up for a scenario like we saw in the kind of the mid 2000s, post 2008, where we just didn't build that much housing because people were gun shy. Especially in a period right now where financing has dried up. It's hard to get financing for new development. So when we're looking at permits in the pipeline for construction, we're seeing a big drop off in deliveries post 2025 just because the interest rates don't make sense. The only thing that theoretically would bring the 10-year treasury down, led by the Fed funds rate, is if we saw some sort of recession, a contraction in GDP that would cause the Federal Reserve to lower the Fed funds rate. We would need to see the unemployment rate increase materially, a lot of job losses, and just in a slowdown in earnings. And we're just not seeing that all pick up. Not that there aren't signs of distress, there aren't worry cards out there, but they're not materializing to a point that would lead us to an immediate recession. Now, a lot of indicators are lagging, things can catch up very quickly, and there's a lot of signs that we could be looking at a recession from a technical standpoint. Again, just looking at the yield curve, it's actually reverting right now. It's been inverted for quite some time, the last 9 months or so. Now it's reverting away where the long end of the curve is steepening, as the 10-year treasury is steepening, while the shorter end of the curve is kind of staying put, anchored by that Fed funds rate at 5.25%. So is it the time to buy multifamily right now? Yes, if you're buying in this band, 6.5 and up. If you're buying below 6.5, it's hard to say you're getting a deal based on just historical technicals. The only way that you could really justify buying an asset below 6.5% cap rate is one, you have a very long hold period, and relatively low expectations for returns. If you absolutely believe that interest rates will be lower in the next couple of months or within a year, which interest rates could be lower within a year or so, they could be, not certainly, then you could speculate that as interest rates fall, cap rates will fall as they did, post 2008, when again after they peaked in 2006, and pretty quickly started their climb back down, to eventually bottoming in 2020 and 2021. So it's a volatile time. It's a lot to navigate. You have to be careful out there because there's a lot of folks, a lot of syndicators and sponsors that still want to do deals because they make money doing deals regardless of if it's a good deal or not. Very few real estate businesses can operate and sustain themselves just through operations, property management fees and asset management fees. Maybe there's a few out there. I really don't know of many property management companies that are even profitable. They make money by doing deals, hopefully good deals, making big exits and kind of getting into that promote from the sponsor. But all of those exits, refinances have been pushed out years. And so there's no income coming in. So you really need to be careful of the offerings that you're seeing. Are we buying at a good price? If it's just there's going to be enough value that's forced through a value add renovation, that could be the case. But we're also entering a period of incredible weak demand. Now it should only last about 18 months, but again, I mentioned that those 1.1 million units that are coming online, being delivered, that's brought occupancy down from incredibly low levels, about 96% average occupancy across the nation. We're now falling back down in kind of historical levels, sub 95%. In some markets that I know of, it went from 98% occupancy, it's now down to 92% occupancy. And rents have declined on average throughout the nation year over year by around 1%, although there are many markets, such as those in the Midwest and the Northeast, that have seen positive growth. In general, growth is weak and values are way down. I haven't even mentioned the amount of outstanding debt in the multifamily industry that will lead to the price discovery necessary to establish this band. There's about $1.9 trillion of multifamily mortgages outstanding. We're going to have about $40 billion come due this month, another $40 billion next month. Many of these mortgages, these properties, were purchased in this time period at the end of 2021. Again, when the 10-year Treasury was still low. It was really low, kind of in the 1%, 2% range. Cap rates were low, but the spread seemed appropriate. There was a good spread there. The problem is investors didn't lock in their interest rate. Some did, but many acquired these assets on short-term floating rate loans. And so where they started paying kind of in the, call it 3% range, so you had an appropriate spread between your, and this is where the Fed fund SOFR would have been, plus their all-in rate around kind of 3.25% to 4%. There was a healthy spread here. But now that interest rate has come up, and so now their interest rate is actually higher than their cap rate. Their operating cash has been brought to zero and is even negative in some cases. This should lead many owners, borrowers, and operators to look for some sort of solution to their asset essentially being underwater. This will come in the form of additional equity injection, either from an outside group or an internal capital call. The worst case scenario would be a foreclosure and handing the keys back to the bank. We've already seen this take place from a number of sponsors in a number of markets already this year, where again, just relatively unsophisticated sponsors bought a lot of large assets, paid way too much for them, and financed them with short-term floating rate debt. They were unable to meet their obligations and they had to hand the keys back over to the bank. This scenario is just beginning to unfold. And so why cap rates, if you look at CoStar's average right now for 2023, we're kind of in the mid 5% range. So, we do have a slight positive spread, but you still see offerings come out from brokers listing properties around the 5% range, basically a zero spread between interest rates and cap rates. Which again, going back to 2006, the previous low of the spread should be at least 150 basis points. So where we go from here, values should be cheaper, yields should be increasing, and fortunately, we should get through the price discovery to re-enter a normal market. Now there is quite a bit of dry powder Not as much as individuals may think there are, because looking at the most recent data, the dry powder is starting to evaporate. It's not being allocated. But there is a lot of interest in multifamily. And again, the long-term fundamentals still make a lot of sense. But the next year and a half are going to be tough from a performance and operations standpoint, and especially from a value standpoint. So what can you do as a multifamily investor on the LP and the GP side? On the GP side, it's time to preserve the asset. If you haven't battened down the hatches, you really should have about a year ago. If you're facing a loan maturity, there are sources out there. If you don't want to go back to your investors and raise additional capital, there's preferred equity options, mezzanine equity options. We're working with a couple groups right now, helping them navigate that process. Be happy to talk to some sponsors of what we've seen work for others. If you're a limited partner, check in with your sponsor, see how things are going. Look through those financial statements. Don't just, take the first couple sentences of the report at face value. Really dig in. See when that maturity is coming due. See what the actual net cash flow is, and also see if the GP has had to contribute additional funds to essentially float the deal and pay debt service. Now's the time to really ask a lot of good questions. And smart sponsors, again, this wasn't necessarily an unintelligent and unsophisticated move to buy assets when the spread was this wide. The mistake came as just paying a little bit too much and not thinking that interest rates could rise. So again, if you're an LP, just dig in, make sure your sponsor is communicating with you, and perhaps think about if that sponsor is the one you want to reinvest with in the future. This is going to keep unfolding. Make sure you're subscribed to the Gray Capital YouTube channel. We cover really this stuff at least more than a weekly basis on the Gray Report. We also have a podcast called The Complex, where we are just all talking about apartment operations. Our director of property management, Katrina Green, leads that podcast. In some ways we're in charted territory, but we are looking at the charts. And again, there's a lot of speculation of where things could go. But I think this is pretty telling, 6.5 to 9.3. Let us know what you think. Comment down below, like this video, get in touch with us. Anyone on the team at Gray Capital, looking forward to talking to you soon.